All right. I'd like to welcome you all to our second lesson for financial reporting and analysis. So this is our second lesson for financial reporting and analysis. In our first lesson, we discussed the definition of what accounting was all about. And then we talked a little bit about the roles of financial statements, where we looked at the 5 key financial statements and their various roles. So today we want to get a little bit deeper into accounting. But before we do that, I just want to highlight a couple of things, just in case maybe you did not attend our last lesson. So like I said, for financial reporting and analysis, I'm going to have a couple of free classes. The one we did on Thursday, the one we are doing today. On Monday, we're going to have another free class, and then next week, Monday, will be the last free class that I have for financial reporting and analysis. Now, these free classes, like I said, is just introducing the subject material of what we want to talk about and just showing you how we are going to go about the module together as we teach each other financial reporting and analysis, right? So like I said from the beginning, it's a module. It can be a little bit difficult, but I believe if you follow through what we'll be doing in class together, it will be an easy ride for you. Because the last class that I had about 18 students. I think from the feedback that I got from them, I think almost like 15, if I'm not mistaken, of them got distinctions, and the other 3 did not get distinctions. But you know, sometimes some people might not really be following what we'll be doing. So I know you can get distinctions from this module as long as you follow through what we are doing together. Then in terms of the cost, let's say that you have gone through the free classes and you're happy with them and you want to continue with the classes. The cost is going to be 800 Rand per semester for the financial reporting and analysis module. That's my recommended package, the one for 800, which includes the lessons, which includes the KCQs, assignment tips, exam preparation, KCQ help, and etc., which means you're basically covered in terms of all the aspect areas. And then when it gets to the exam, you will be prepared to do the exam on your own. So that's the package that I recommend. But I do have other packages which we can discuss on one basis in case you don't want to join the classes, right? So that's on that part. Then just a little bit of a revision, maybe for 5 minutes, in terms of what we did yesterday. So we introduced financial reporting and analysis, and we said it is about the study of accounting. And I highlighted that accounting is looking at how do we measure, process, and communicate financial information. So we are going to be doing a lot of measuring financial information, processing financial information, and learning how to communicate it appropriately to the different stakeholders that are within a business. And I said that when we are communicating to the different stakeholders that are in a business, we use 5 key financial statements. We use what? 5 key financial statements. The comprehensive income statement, the statement of financial position, the statement of changes in equity, the statement of cash flows, and the notes to the financial statements. So all of these are found within the financial statements of an organization. And each and every one of them represents a certain aspect of how your organization functions. So for example, the statement of comprehensive income is looking at what is the sales or what is the revenue and what are the expenses of the organization? What is your financial performance within the past year? Whereas the balance sheet or the statement of financial position is looking at the value of a company on a particular date. So each and every one of these statements represents a specific aspect of the business. I would encourage you to go through the video that we did on Thursday if you did not attend on Thursday, because we go a little bit deeper into some of those aspects and discuss them more, right? Then in addition to that, yesterday we looked at the difference between financial accounting and managerial accounting, where I highlighted that this current semester, we are more looking at financial accounting. But when you go into your second year, that is in February next year, we are going to be together again for management accounting. So financial accounting is looking at the past and trying to present, right, or to report information that happened in the past. Whereas managerial accounting is about making decisions. You're saying, I have this information. What decisions can I make to improve the performance of a particular organization, right? So we talked about that. Then lastly, we looked at the users of financial information, where we said that the internal users and external users, the internal users being the employees of an organization who want to know about their salary, or the management who want to make decisions. And the external users, we looked at bankers, creditors, governments, and etc., who each and every one of them, they have got a specific role in terms of what they use financial information for. So this is actually a typical KCQ question, where they will ask you, what does this user use the information for? So they can say the government, what does the government use financial information for? Or what does an auditor use financial information for? And etc. So it's you usually find these ones when you do your assignments, your KCQs, those types of questions, right? So that's what we covered on Thursday. So today now we want to cover the remaining parts of unit of some of unit number 1, not everything, but some of unit number 1 that we want to cover, right? So if you check in your study guide, I think it's under 1.7, classification of financial information. So I want to jump a couple of things and go to that one directly, because the reason why I'm jumping some of those things is most of the terminology that we will be using is what we want to discuss right now. So that when I talk about assets, when I talk about liabilities, when I talk about equity, expenses, and income, you have an understanding of what I am talking about. You can visualize what I am talking about at the end of the day. So we want to look at 5 key terms that are used in accounting. 5 key terms that are used in accounting, right? So these are assets, liabilities, equity, expenses, and income. So any discussion that you have in accounting, right? Whether you're doing your income statement, or you're doing your balance sheet, or you're doing your statement of cash flows, or you're doing your statement of changes in equity, you are talking about these 5 key things. That's what you're talking about. So that's what I want to introduce to you. And then we can see, oh, this means that, this means that. And then it becomes easier for me to communicate to you guys when I'm communicating in financial terms. Right. So let's look at the first thing. The first thing is an asset, right? So what is an asset? When I say asset, what comes to mind? So an asset in basic terms, from the definition, you can see the slide there, is a resource that provides economic value to a business. It's a resource that provides economic value to the business. But when we're looking at an asset, we are saying the economic value that we are talking about is a future economic value. That's the economic value that we're talking about. It's a future economic value. That's what an asset is. So for example, if you are in, let's say a Takealot, right? Takealot, you know Takealot, right? If you are Takealot and you have got a delivery vehicle that you have as a Takealot, we consider the delivery vehicle to be an asset. Why? Because we're saying the delivery vehicle will provide economic value to the business. Why? Because it's going to deliver products to our customers, and these customers are going to pay us when we deliver these products. So that's an asset, right? Or for example, maybe you are a company that is, you are HomeNet or RentNet. You are a company that is in real estate, right? You have a building, right? The building becomes an asset. Why? Because they're saying this building in the future, we can rent it out to some tenants, and these tenants can provide us what? Can provide us some rentals. So you have a resource in the form of a building, and that resource, you own it as a company, right? You own that resource as a company, and it's going to provide a future value in the form of what? In the form of rentals, right? Or if, for example, you're looking at something that is called a patent. Right? I don't know if you guys know what a patent is. A patent, for example, if you are in pharmacy, right? You are in the pharmacy industry, right? You create a drug, right? Let's say paracetamol, right? You create a drug called paracetamol, which is a painkiller, right? So you can go and register it with the government that we've created this drug. The formula for creating this drug is this a chemical plus this chemical plus this chemical, and they will create a patent, which means that legally no one else can create the same drug that you have created. So that patent now is an asset to you as an organization, because it is a resource that you have as an organization, and that resource is going to provide you future benefit in the form of income when you sell either the patent or when you sell the drugs to different pharmacies or to different patients in the future. So the patent becomes a what? Becomes an asset. So assets by their very nature, they can be distinguished between different types. So there are assets that are tangible, which means that you can hold the asset. You can hold and say, this is my asset. So for example, a car, you can hold a car. Or if you're at a company, maybe an office chair, you can hold an office chair. So that is a tangible asset. Or an asset can be intangible, which means that you cannot physically hold the asset, right? So for example, what we call intellectual property. Intellectual property, it's something that you've created that cannot be held, but that belongs to you, like an idea that you've created, just like we're talking about a patent, right? You cannot physically hold the patent, but it's an idea that you've created, and it becomes intellectual what? Intellectual property, right? That's an intangible asset, right? And then assets can also be current or can be non-current. Now, this is actually a typical exam question, trying to distinguish between current assets and non-current assets, right? So a current asset is an asset that can be liquidated within the following 12 months. 12 months. If it can be liquidated within the following 12 months, it falls under current assets. So for example, if you have got cash, cash is considered in current asset because it's liquid in its very nature. Or for example, if you have stock, let's say that you are Mr. Price, you're selling clothes as Mr. Price, right? So you have got clothes that are in the shop that you know that maybe someone will buy the clothes this month, or maybe next month, or maybe within the next 6 months, these clothes will be bought by our customers. So they are considered what? Current assets, and they're called inventory. That's inventory or stock. You say, oh, we've got stock or we've got inventory. We are saying that you've got goods that are available within the shop that you are going to sell within the next 6 months. So that is a current asset. You can liquidate it within 12 months, right? When we say something is non-current or it is fixed, we are now saying that this cannot be liquidated in the following what? In the following 12 months. So for example, if you buy a building as an organization, right? You don't expect to sell the building within the next 12 months. You expect the building to continue servicing the company, maybe use it as your office, or maybe you're going to get rentals from it, whatever it is, right? But you're saying that you're going to use this building for the next 12 years, for the next 10 years, for the next 5 years. So it's considered a non-current or a fixed asset. It's fixed in its very nature. So you have to be able as a student to differentiate between current assets and non-current assets. So there's a little homework that I'm going to give you guys. So if you check the next slide, I'm going to send these slides after the class. If you check the next slides, you can see over here, it says here, the name of the asset, the description or a definition of the asset, whether it is a non-current asset or whether it is a current asset. This will help you understand, because we're going to get deeper and deeper and deeper into accounting. So you need to know what these different things are. Right. So if you go back to my slide there, you will notice I've highlighted in yellow. These are different types of assets. You've got stock, inventory, plant and equipment, buildings, vehicles, goodwill, patents, cash, debtors, prepayment of expenses, office chairs, stationery in a storeroom, intellectual property. These are different types of what? These are different types of assets. So I need you guys to go through these assets and then put the name of the asset, describe what the asset is. Do you understand what that asset is? If you don't understand it, search it on Google so that you can know what that asset is. Those assets that I've given you, these are the normal type of assets that you might see in an exam situation, right? And then highlight whether it is a current asset or it is a non-current asset. All right. So here I'm just going to pick one which I know you guys might struggle with, and just highlight this one, and then we are done with assets. So a prepayment, right? When we say something is a prepayment, so for example, let me come back home. So for example, if you have a house, let's say for example, if you've got a house, right, and you've got your water bill that you receive at the end of the month, right? So when you receive your water bill, you pay your water bill. Let's say that you decide that, you know what, I don't want to have problems with the city council. I'm gonna pay my water bill upfront for the next 5 years. That's what you've decided. I'm going to pay my water bill upfront for the next 5 years. So this is an expense, right? It's not an asset, but it's an expense. But this expense, you have prepaid it in advance. This expense, you've prepaid it in advance. So it's called a prepaid expense or a prepayment. So a prepayment is considered an asset. Why is a prepayment considered an asset? Because we are saying you have not consumed the water for 2024. You have not consumed the water for 2025, but you have already paid the bill in advance. So what happens, let's say, for example, you say, I no longer want to get water from the city council, which means you can actually go to the city council and tell them, guys, I paid you my water bill for 2024. I paid you my water bill for 2025. I paid you my water bill for 2026. Can I have my money back? You can actually do that. You can write them a letter, send them a letter, and they will pay you your money back because you have not yet consumed the water for those years. So it's actually an investment, sort of. So it's an asset that you have. So please take note, a prepaid expense is an asset. Now, the opposite of a prepaid expense, right, is, let's say that you were supposed to receive income, but you did not receive that income. That becomes what we call a debt. Right? That becomes what you call a debtor, or what we sometimes call accrued income. A debtor or accrued income. Accrued income or debtors, these are people that you have given services to, but they've not yet paid you. So it's an asset to you. You're saying they will pay me in the future for services that I gave them today. So they become debtors to you, or it becomes an accrued income, i.e. an income that has not yet been paid to you, but was supposed to be paid. So I think those are the ones that I think you might struggle with. I hope it's clear for everyone here. For assets, we can move to the next one. If it's not, please highlight so that I can explain further. So that's assets. We now move to liabilities, right? So a liability now is when you owe someone money. That's a liability. When you owe someone money as a company, right? So for example, as a company, you can go and take a loan from FNB to start your business, right? So which means that loan becomes a liability because you owe FNB 1 million rand for the loan that you took from them to start your business. Or let's say, for example, as a business, right, you are selling your incredible connection, right? And you are selling computers, right? You're selling HP computers, MacBooks, Dell, Acer, whatever computers that you're selling. And then you approach HP, right, or Dell, and you say, can you give us 100 laptops? We want to go and sell them at our shop, but we will give you the money for the laptops maybe in 3 months' time. That becomes a creditor. So it's again a liability because you're saying that although you are selling these laptops for Dell, right, you did not pay them for the laptops. You're going to pay them in 3 months' time. So that's a liability. You owe Dell or you owe HP some money. So there are different types of liabilities that you're going to see, right, when we are starting to do our exams and our KCQs and whatnot. But usually you just divide liabilities into two: current liabilities and non-current liabilities. A current liability, it is a liability that you are going to pay within the next 12 months. If you owe someone money and you're going to pay them within 12 months, then it is a current liability. If you owe someone money and you're going to pay them after 12 months, then it is a non-current liability, right? Please take note of that distinction. It is very, very important. So again, I've given you guys a little homework, right, where you can go through. If you see I've highlighted in yellow different types of liabilities, I want you guys to highlight the liability, describe the liability, and show whether it is a non-current or it is a current liability. So that's a little homework that I've given you guys again, right? So again, this helps you because when you get into an exam, you're going to be given a list, right? A trial balance. This trial balance will have assets, will have liabilities, will have expenses, will have incomes, and then you're supposed to create an income statement. So for you to create an income statement, you need to be able to distinguish that this is an asset, this is a liability, this is an expense, this is an income. This is a current liability, this is a non-current liability. You need to be able to differentiate between those things for you to create proper financial statements. So please do this little homeworks that I'm giving you that will help you. So when we meet next time, I'll even show you what the answers were supposed to be, right? So maybe let me pick one or two from my list here just to show you what I'm talking about. So for example, let's look at dividend liabilities, right? Dividend liabilities, or what are called accrued dividends. Right? So as an organization, when you get to the end of the year, and let's say you've made a profit of 1 million rand. So after you make your profit of 1 million rand, you decide we want to give the owner of the business 500,000. That's what you've decided as managers of the business. Oh, we made some profit. Let's give the owner some of the profit. Because businesses don't pay the owners all of the profit. They pay them some because you need to invest more into the business. So you decide we're going to give the owner of the business 500,000, right, as part of the profit that we give to him. But making the decision that you're going to give them and actually giving them the money are two different things. So you can make the decision in December that the owner of the business, look, we made 1 million in profit. We are going to give you 500,000 as what? As a dividend. But you might actually pay them maybe in February or in March. So before that whole time when you haven't paid them, it's called an accrued dividend. It's a liability. It means you owe the owner of the business some dividends. So it's the same thing with taxes. The government can charge you and say, look, you guys are supposed to pay 30,000 in taxes. But as long as you have not yet actually transferred the cash from your account to the government, it's a liability, right? It's accrued tax. It's a tax liability that you have as what? As a business. Or your expenses. We were talking about the water bill earlier, right? You get to the end of the month, the city council tells you your water bill, it's 700 rand this month. You don't pay it, right? I'm sure most of you guys there, you have water bills that you've not paid, right? So let's say you go 3 months without paying your water bill. Some companies go years without paying their water bill. 3, 4, 5 years without paying their bill. So that's an expense. But that expense is a liability because you were supposed to pay it when you were presented with the bill, but you did not pay it. And because you did not pay it, it becomes a liability to the organization. So it becomes an accrued expense. So I think you can see the difference now. There is prepaid expense, expense paid in advance, and there's accrued expense that is owing. So you need to be careful about those things, because those are some of the tricky things that I see students struggle with. What is the difference between accrued expense and prepaid expense? What is the difference between prepaid income and accrued income? You need to know the differences between those what? Those particular terms, right? So that's liabilities. So go through the list of liabilities, right? Distinguish between the different ones, highlight what is the definition of each liability, and highlight whether it's current or non-current. Remember, current within 12 months, non-current over 12 months. So that's liabilities. Let's go to income and expenses, right? So remember, I said that there are 5 terms. We've done 2 so far. So let's look at income, right? Income for a business, when you say a business has got income, it's just basically an increase in the economic benefit of a business that arises as you are doing your general business. So for example, if my business is delivering, right? If my business is delivering, and after the whole day of delivering,
bed filling come with disappointment.
Hello, is that a question? So if you have done your business, let's say for the whole day, you've delivered products, you've whatnot, and after you've done all of that, at the end of the day, money comes into your account for the services that you've rendered. That is called an income. So, for example, if you're selling laptops, you're going to have sales for the laptops that you're selling, revenue coming in. If you're in real estate, you're going to have rentals that you're going to receive from your real estate business. If you're selling airtime, you're going to have commission from the from Vodacom or whatnot for the airtime that you have sold, right? So whatever revenue or income or sales or rentals that you are receiving, right, the benefits that you are receiving for the ordinary activities of your business, this is what is considered an income. So sometimes we say an income is an increase in the assets of the business or a decrease in the liabilities of a business, although this can be confusing if you define it like that. It can be slightly confusing. But in general, if you see the assets of the business are appreciating over time, that business is earning an income. Or the liabilities of a business are declining over time, we say that that business is what? Is gaining an income, right? But in essence, it's just inflows, right? Economic benefits that are accruing to the business because of the activities of that particular business. Now, income in its very nature, we're going to define what equity is, but just in short, income in its very nature increases equity of a business because income is a benefit to the owner of the business. So income increases equity in the business because it is a benefit to the owner of a business. Now, when you are conducting your day-to-day activities of a business, you are going to face a loss of value. The loss of value can be in the form of depreciation or reduction in the value of your assets, or can be in the form of actual expenses that you have to pay. So for example, if you're operating a real estate business, you need to pay someone to clean the houses that you are renting out. You need to pay a plumber to make sure that the plumbing is done correctly. You need to pay an electrician to make sure that the electricity is functioning correctly. You need to pay a painter to make sure that the houses are in good shape and condition, right? If you're in delivery business, you need to pay for fuel expenses, right? You need to pay for fuel for you to be able to deliver to your consumers. You need to pay the drivers their wages and their salaries, right? So there are day-to-day costs that the business faces, and these are regarded as your expenses. So they can be tangible in the form of like you are physically paying. I'm paying my wages, you transfer money. I'm paying for the pen that I'm using at the workplace, right? You transfer money. I'm paying electricity. I'm paying for water. You transfer money, all of those different things. Or they might not be physical. You might not have to pay actual cash. So for example, if you have a car at the business, the moment you use the car, that is wear and tear. Wear and tear in accounting, we call it depreciation. Because we're saying the moment you use that car, the tires of the car are going to be worn out. The engine of the car that you're using to deliver is going to be worn out, which means that the value of the car is going down each and every day you are using the vehicle. So that's depreciation of the asset. Although you're not physically paying cash, but the value of the asset is declining. And that is also an expense to the organization. I'll bet it's a non-cash expense, but it is an expense. So expenses can be non-cash or can be cash related, right? Cash expenses, you're physically paying cash. Non-cash expenses, you are not paying cash, but there is a decline in the value of your assets as a business, right? So I told you that income increases equity, right? It's a benefit to the owner of the business, but expenses decrease equity because they are a cost to the owner of a business. So below they highlighted in yellow, these are a lot of different types of assets, liabilities, incomes, and expenses, which I want you guys to Again, a little homework that I want you guys to go through. So you highlight what is the name of that thing, you highlight the definition of it, you highlight the category. Does it fall under assets? Does it fall under liabilities? Does it fall under income? Does it fall under expenses? Because these are the type of things that you might see in an exam situation, in your trial balance, and you're supposed to allocate them under either expenses or incomes, under either assets or liabilities of an organization. Some of them are a little bit more difficult, purposefully. Some of them are very, very straightforward, but please make an effort to go through them. This will help you help you have the correct terminology for accounting, so that when we are discussing these things in classes, you can understand them at a better level than getting confused because of some of the terms that I'm using. So the last one, which is equity, right? Equity represents the owner of the business. So we said asset is a future economic benefit. It's a resource that gives you future economic benefit. And we said liability, right, It's something that is going to give you a future expense, right? It's you owing money to someone which you have to pay up in the future. Then income we said is current income or current benefit that you are deriving from what? From activities of the company. And the expenses, we say these are the current costs or depreciation in the value of the assets because of the activities of the company. But equity now, equity is what the owner has invested in the company or what the owner has gained in the company. So it represents the stake of the owner of the business. Sometimes we say after deducting all other claims, i.e. after removing liabilities. Right. So you're going to have assets in a business and you don't own all of the assets in a business. I want that to be clear. If you know here that let's say F&B, if they say F&B has got 5 billion in assets, and then they tell you, oh, this specific person, Mr. Smith, owns F&B. It does not mean that Mr. Smith owns 5 billion in assets of F&B. No, right? We are saying that the assets of F&B, there are liabilities that are in there. So you need to remove these liabilities for you to be able to tell what is the equity of that specific person. There's a formula that I'm going to show you later of how to do that, right? But equity represents owner's stake, right? Or owner's claim within a particular business. Now, when we start doing our financial statements, you're going to see a lot of different terms that affect issues to do with equity, right? So for example, you're going to hear the term capital, right? Capital. Capital, it simply means the amount of money that the owner has invested in the business. This, we usually talk about it when we are talking about sole traders, people that own the whole business by themselves. That's when we usually talk about capital, right? The amount of money that someone invested in a business. We're going to talk about ordinary shares. Ordinary shares, this is when we're saying that maybe a company is a public company, right? It's traded on the stock exchange. For that company to get more money, it's going to issue shares. So they're going to say each share in the company is worth 100 rand, right? And then you pay 100 rand and you're given 1 share in the company. So if you want 20 shares in the company, you pay 100 multiplied by 20, you pay 2,000 and you get 20 shares in the company, which means you own 20 parts of the company at the end of the day. So ordinary shares, these are people that own the company, but they are owning a small part of the company. If you combine them together, they will give you the total capital of the business. We're going to talk about preference shares, but not now. This is going to be when we're doing managerial accounting next semester. We'll talk about preference shares. We're going to talk about drawings. Drawing, this is when the owner of the business removes money from the business, right? If the owner of the business removes money from the business, it's going to called what? Drawings. We're going to talk about retained earnings. Retained earnings, this is a situation whereby you make profit, 1 million in profit, you pay the shareholder maybe 600,000 in dividends, right? But you did not pay them 400,000. That 400,000 that you did not pay to the owner of the business, it gets invested again into the business. That's a retained earning. Then capital reserves, this one is, I won't discuss it right now. It might confuse you. It's more important for the guys that do accounting. When we're talking about how the shares were issued and what issues of revaluations and whatnot, but it might confuse you, so I will not discuss it because I don't think this one will apply to you guys. But the ones that you really need to know about are ordinary shares, the issues of the capital account, and the issues of the drawings, and the issue of retained earnings. These ones, you will see them pop up here and there. I will explain it when it pops up, but you'll see them popping up. But all of these things are related to equity of a business. But in short, equity represents the owner's stake within a business, right? So those are our 5 key terms in a business. Those are our 5 key terms: asset, liabilities, equity, expenses, and income. Now that we know these things, how are these things related? How are assets, liabilities, equity, expenses, and income related? These things are related through what is called the accounting equation. Your understanding of the accounting equation will make your life easier in terms of a lot of the things that we are going to be talking about, because anything that we do in accounting is based on the accounting equation. Now, for the purposes of your study module, you don't go too deep into these things, right? But I'm just going to give you an overview of it so that it helps you in terms of understanding. You don't go too deep into the accounting equation. This is mainly for the accountants, right? But we're going to just do an overview of it so that you have a basic understanding of what we mean. Because we're going to talk about double entry, right? You need to know how to define double entry. It comes from the issue of the accounting equation. We're going to talk about issues to do with the gap, the various rules, materiality concept, a realization concept, and whatnot. All of these, your understanding of them is usually better when you know what the accounting equation is all about. Right? So the accounting equation says that in accounting, when you are recording, when you are measuring your assets, when you are processing your information, the assets of the organization are always equal to the equity plus the liabilities of an organization. This is what gives you the statement of financial position or the balance sheet, one of the statements that you're going to have to learn to do. Right? The assets of an organization are always equal to the equity plus the liabilities of an organization. So what are the assets? Assets are what we have. Remember, economic resources that the company owns, those are the assets, is equals to what? How did we buy those assets? Did we use our own money, which is equity, or did we borrow money from the banks, which is liabilities? So assets are always equals to how did we buy the assets? If we bought the assets using our own money, then assets is equal to equity. If we bought the assets using creditors, if we borrowed money, then assets is cost to liabilities. If we combined, if we used part of our own money and we also borrowed some money, then assets is equals to equity plus the liabilities of the what? Of the organization, right? So that's the accounting equation, right? Or in other terms, the value of the company is equals to how it was financed. It's always equal. The value of the company, if I say the company is worth 5 billion, I can show you how the company was financed. I can show you, oh, 1 billion of it was equity, 4 billion of it was a liability or something like that. All right. So I want to start with something that is simple. Okay. Okay, so let's do this. Just give me a second here. Okay, what's happening here? Accounting equation. Oh, fine. That's where we are. Right. So I want you to start with 100,000, right? So let's assume you are just you, huh? It's James, and James has got 100,000 in his account. How could I represent this on the accounting equation? I've saved money, I've got 100,000. So the question is, does James have any assets? Yes, I've got cash. Cash is my asset, right? That I have in the account. And that cash is equals to what? 200,000, right? Is equals to, does James have any equity? Do I own the 100,000? Yes, I own the 100,000 because it's mine. It's my savings that I've made, right? So I own the 100,000. So you can see that my accounting equation here is 100,000 is equals to 100,000. It is balancing, right? But then as James, I make a decision. I want to start a company. I want to start a real estate company. Real estate, I'm selling houses. Right? So what do? I noticed that for me to get one house, the house is going to cost me 1 million rand, right? But I do not have 1 million rand. I only have 100,000 rand. So I approach FNB Bank. Right? After approaching FNB Bank, FNB approves a loan of 900,000 to me. So I take my 100,000, which was cash, and I pay it to the owner of the house. Then I take the 900,000 that FNB has given me, and I pay it to the what? To the owner of the house. And the owner of the house gives me the title deeds. Right? So how do I represent that? So I have now converted these things. I now have got an asset worth 1 million. Because remember, the price of the house was 1 million rand. So I have an asset worth 1 million rand. But according to accounting, assets are always equals to equity plus liabilities. So these assets, this 1 million rand in assets, how did I buy this house? I used 100,000 rand, which is my equity. And I used 900,000 rand, which is a liability, a loan that I got from FNB. So 1 million rand is equals to what? 100 that I use, which is myself, plus 900 for FNB, which gives me what? Which gives me 1 million. So again, my accounting equation is balancing. I've got 1 million on one side and another 1 million on the other side. So what if I did not want to use my cash? What if I did not want to use my cash? I just wanted to take all of the money from the bank. What then happens? If I did not want to use my cash, this is what would happen. I would buy the house, right? Which means I have 1 million from the house. Then I would still have my cash in the bank account because I did not use my what? Because I did not use my cash. I would still have my cash in the what? In the bank account. And then my equity, I would have 100,000 equity, plus now my loan is no longer 900 because I borrowed the full amount from the bank, which is 1 million. So if I check there, my accounting equation will still balance at the end of the day. It's just that it has different figures now. It has got 1,100,000 is equals to 1,100,000. So it's still balancing at the end of the day. So whatever transactions, whatever movements happens at their company, the accounting equation will always balance. And that is why when we start to do the balance sheet, I will tell you guys, your balance sheet should always balance. Yes, you can make mistakes and it might not balance, but the bottom line is your balance sheet should always balance, because the balance sheet or the statement of financial position is represented by the accounting equation. The assets, the total assets should always be equal to the total equity plus liability of an organization, right? Let's get a little bit more creative, right? Let's get a little bit more creative just to show you what we are talking about, right? So again, same concept. We've got an asset worth 1 million rand, which is the house. And then we've got equity, which is the money that I contributed to buy the asset for the 100,000, and liability, which is the loan that I took from FNB, which is 900,000 rand. Then, because remember, I started the business, right? So in this business, let's say that I want to sell the house. What do I do to sell the house, right? I have to put an advert for me to sell the house. I have to put an advert, right? And that advert is going to cost me 1,000 rand. But guess what? If you check my bank account, I have zero money in my bank account, right? I have got zero money in my bank account, right? So maybe I've got some cash that I have that I can get maybe from a relative or something that I can put into the account, right? So we're now saying this 1,000 rand, right? Because I don't have it in my bank account, I can go and borrow, right? Maybe from the bank again, overdraft, right? Maybe I overdraw the account. So if I overdraw the account to put this advert, what have I done? The house is still there. The asset of the house is still there. Is equals to, what about my equity? Remember, I told you guys that income increases equity and expenses reduce equity. The 1,000 that I am going to pay for this advert, the 1,000 that I am going to pay for this advert, it's an expense for the organization. So it's going to reduce my what? My equity, right? So I'm going to say minus 1,000 on my equity there, right? Plus, I still owe the bank 900,000, right? For the house. But in addition to the 900,000 for the house, I now owe the bank what? Another 1,000 for the overdraft. Am I still balancing? If you do your mathematics there, you can see that I still have 1 million on the other side, on the equity and liability side. So I am balancing. So this is what happens in a business, right? When we talk about double entry and whatnot, you notice that's what we are talking about. We are saying that you have to balance out your equation at the end of the day, right? Again, same concept. If the council charges me money for it, and I take the money out of my account, again, I've overdrawn the account. It's going to have the same what? The same impact, right? So let's do this. All right. So I've got 1 million here, right? Is equals to 100,000 minus the 1,000 for the advert minus the 5,000 for the what? For the bill that I got from the council. And now I owe the bank 900,000 plus the 1,000 overdrawn plus the 5,000 overdrawn that I owe the bank. If you do your mathematics there, you will notice that I am still balanced. If you add these things up, you still come to 1,000, 1 million, right? And then I sell the house. I sell the house for how much? 1,500,000. Right. That's what I sold the house for, 1,500,000. And the person that I sold the house gives me 1 million in cash and gives me 500 and say 500,000, I'm going to give it to you in 2 months' time. So what has happened here? I've sold the house. So I no longer have the house, but I have 1,000 cash that I received for the house. Plus, I now have an asset called a what? A debtor. Remember, we talked about debtors. Right, someone who owes me money that they're going to pay me in the future, right, is equals to, right, I've sold the what? I've sold the house. So this other side is still the same. It's going to be 1 million. Nothing has changed on this side, right? It's going to be 1 million. Nothing has changed because I still what? Got equity. I still have got what? I still have got liabilities. If you want, we can just write it correctly so that it doesn't confuse us. We can just copy everything there like this. Right? But here's the interesting thing. I sold this house at a profit. And what was my profit? I bought it for 1 million and I sold it for 1.5 million. So I've made 500,000 profit. And we said income increases what? Increases the income increases the equity of a business. So again, if you do your mathematics there, you will notice you're still balancing. You now have got 1.5 million on this side of the assets, and you've got 1.5 million on the side of the equity and the what? And the liabilities. And then again, if you put the last entry, you what? You make your payment, you pay back the bank loan. You should still end up balancing at the end of the day. So that's what the accounting equation is all about. So you might not get very complicated questions on this one. Like I said, it's not really too much of your subject matter. But usually in your KCQs, your lecturer might ask you to advise how this will impact. He might tell you, if I pay money back to the bank, what is it going to affect? How is it going to affect my assets? How is it going to affect my liabilities? So you should be able to tell that, okay, so if I pay money back to the bank, this is what happens. I've paid the bank using cash, so my cash is going to be reduced. Right? I've paid the bank using this, so this is going to be reduced. This is going to be increased and whatnot at the end of the day. So you should be able to tell each transaction, how does it affect assets, how does it affect equity, and how does it affect liabilities. So for example, if I ask you this last question, right? This last one, how does it affect the different things? So I can write here, in terms of my assets, if I pay the bank back 900,000, right? And they charge me 100,000 in interest, I'm going to see a decline in assets because I'm going to what? I'm going to have to pay them using cash. So there's going to be a decline in assets. But in addition to the decline in assets, there's going to be a what? A decline in liabilities. Right? So decline in assets, 1 million, right? Decline in liabilities, 900,000, because liability was what? 900,000, right? and there is going to be a decline in equity because interest is an expense, right, of 100,000. So those are the typical exam questions that you're going to see now, where the lecturer is asking you, what is the impact of this decision on the assets? What is the impact of this decision on the liabilities? What is the impact of this decision on the equity of a particular business? So you should be able to tell this decision is affecting assets. How is it affecting assets? This decision is affecting liabilities. How is it affecting liabilities? And this decision is affecting equity. How is it affecting the equity of a business, right? So we're going to do just one more example before we move on to our next thing. Just one more example before we move on to our next thing, so that we know that we've captured this part correctly. Okay, just one more example. So let's assume, right, you have a business, right, that has got what? Assets, 500,000 rand, and then equity, they have got 100,000 rand, and then liabilities, they have 400,000 rand. So remember, accounting equation, assets is equals to equity plus liabilities. It should balance. 500,000 is equals to 100 plus 400, should balance. So what happens? How are assets, equity, and liabilities affected? For example, let's say the business sells stock worth 100,000 rand. That's what the business has done. They've sold stock worth 100,000 rand. Right? So how does that affect assets, equity, and liabilities? So let's start with assets, right? So if you sell stock, right, stock or inventory is part of assets, right? So this is going to be a inventory decline, right, of what? Of 100,000 rand. That's your first impact. Let's look at equity. How has equity been affected? If you sell inventory, right, you're going to make income that is generated by the business. You're going to make what? Income that is generated by the what? By the business. So equity, you're saying you are generating income. So there's an increase in what? In equity of 100,000 rand, right? And then liabilities. If you sell inventory and you sell the inventory in terms of cash items, it's not going to affect the liabilities. So no effect on the what? On the liabilities. Let's look at another example. Let's say that the business pays off its bank loan 50,000 rand. How is that going to affect our transactions here? So assets, if they pay off the bank loan, we're going to see a decline in cash. Decline in what? In cash under the assets of 50,000 rand. Under equity, we're just told that they paid the bank loan, but we're not told if there was interest, right? If we're not told that there was interest, then there's no effect on the equity. But if there was interest, interest is an expense. That's why I wanted you guys to understand what's a liability, what is expense. Interest is an expense, but there's no interest highlighted here, so there's no effect on our equity. Liabilities, if we paid off 50,000, it means our liabilities reduce. So bank loan reduced by what? By 50,000, because we paid off 50,000. So that's essentially what you need to understand at the end of the day, right? So I'm done with this part. I think we can go to my next part. All right. So that's the accounting equation, right? So that's the accounting equation that you need to understand. So now we want to look at point number 1.4. That's what we want to look at, the general accepted accounting practices. So we've looked at point 1.7, which is classification of financial information, and we've highlighted What are the five key things, right? The assets, the liabilities, the income, the equity, and etc. Right? And then we've explained what is the accounting equation and how the different movements happen within the accounting equation. Are there any questions on this before I start talking about 1.4, the accounting standards? Are there any questions on what we've done? Anything that you need clarity on? All right. Assume everyone is happy. So this one that we're doing now is a bit of theory. This one is a bit of theory when we're looking at the accounting standards. Okay, let's see. Where are my accounting standards here? All right. So in your study guide, if you're following through a study guide, we've gone to 1.4. If you're following through a study guide, we've gone to 1.4. We are done with 1.7. We've gone to 1.4. Right. So when you are operating your business, right? And when you are an accountant at a business, right? When you're doing your reporting, financial reporting, there are certain rules and regulations that accountants have to follow. The reason for following these rules and regulations is so that there is consistency within what is reported by different accountants. So that if I am looking at the financial statements of F&B and I'm looking at the financial statements of Capitec, I can easily compare the financial statements of these two organizations. So for me to be able to do that, it means that they have to be prepared using the same formulas. They have to be prepared using the same ways, using the same guidelines. So these guidelines are what we know as the International Financial Reporting Standards, right? So for those of you that are doing accounting, you are going to go into detail in terms of this. But for the general guys, yeah, you don't need to go too much into detail. You just need to know what are called the principles. So the guys that created IFRS and GAAP, they have certain principles that they said every accountant should agree on those principles. So you as students also who are going to be talking about financial reporting and analysis, right? You also as the future managers of your organizations, you need to understand these accounting concepts, because understanding these accounting concepts will give you a better understanding of the financial statements that you're going to analyze or that you're going to go through. So the first key concept is called the accounting entity concept. The accounting entity concept says that there should be a separation of the transactions of the business and the transactions of the owner of the business, which means that the business stands by itself. It is not the same as the owner of the business, right? Which means that the owner of the business cannot take money from the business and pay the school fees of his own children and then put it as a business expense. That is not allowed when you're doing accounting. If you take money of the business, it's regarded as a drawing. The owner of the business has taken money out of it. You cannot say that under the expenses of the business, you're going to say school fees for the owner of the business. Under the expenses of the business, okay, just lost electricity this side, but don't worry, we can continue. You cannot say the owner, this is the lunch for the owner of the business, this is the type of the owner of the business or something like that, right? The transactions of the owner of the business should be separate from the transactions of the business. That is the accounting entity. You should be able as an accountant or as a manager to say this is what the business got as income, and this is what the expenses of the business were. These ones have nothing to do with the business. This was the owner of the business. Hence, we have not included them in what we are doing, right? Okay. But take note, like I said, if there is any relationship between the business and the owner, it should be under capital and drawings. Not income and expenses. It should be under capital and drawings. That's where you should record those things. Okay? The next thing is called the money measurement. So when you're doing accounting, you're going to face very interesting things. For example, maybe you are a farmer, right? And you want some bulls right, for your farm, right? You're into cattle ranching and you want some bulls. So you can talk to another farmer and agree with that other farmer. Look, I want the bulls that you have, but I don't have cash at the moment. Can I give you maybe 2 tractors instead and you give me 1 bull, right? And that deal can happen. But in accounting, we don't record as in so we have this transaction in our accounts where we exchange 1 bull for 2 tractors. We don't do that in accounting. We transform everything into monetary value, right? We transform everything into monetary value. So the money measurement concept simply states that all your assets, liabilities, equity, income, and expenses should be expressed in terms of rands, right? You cannot say this business is good. For example, if I tell you right now, go to the Johannesburg Stock Exchange and look at Vodacom, the financial statements for Vodacom. The financial statements will not tell you that Vodacom has got 33 buildings, it has got 22 boosters and whatnot, it has 33 computers. They will not tell you that. They will just tell you computers with 50 million rand, buildings with 30 million rand. That's how accounting is done, using money. We don't look at the actual physical quantities. We look at money. The same concept also applies. Vodacom might operate in 20 different countries, but their financial statements will be in rands. They will not tell you that in our financial statements, this is USA, this is Zimbabwean dollars, this is Namibian dollars, and etc. They will show you in rands. Everything is summed up into one currency and presented as one currency. They might have notes to explain a couple of things, but everything will be in rands. So that is the money measurement concept. Right. The next one is called the materiality concept. The materiality concept simply states that when you are preparing your financial statements, there are things that are material and there are things that are immaterial, right? There are things that are material and there are things that are immaterial. So for example, if you've noticed when you're preparing your financial statements, they might not be in cents. They might not tell you that this company, F&B, they've got 33,500,022 cents in asset. They might remove the cents and say the cents are immaterial, right? For example, right? Because it's immaterial to the value of what they're talking about. Or, for example, they might under assets, they're not going to say buildings, then after buildings, motor vehicles, and then after motor vehicles, tables and chairs, then after tables and chairs, ballpoint pens, and then computers, laptops, mouse, and whatnot, iPads, cell phones. They will just tell you electronic equipment. You are summing it up because it is immaterial for you to list all of the different assets, rather just give one single value of all of them at the end of the day. So when you're doing your accounts, you have to highlight what is material and what is immaterial in your statements and record only things that are material for your business, and things that are immaterial, don't worry about them. Right. Historic concept. When you are presenting specifically the statement of financial position, when you are presenting your information, you should use the historic value, the original cost. So for example, if I bought my car, right, in 2020 for 80,000 rand, that's how much I bought it for, 80,000 rand in 2020. If today the value of that car is now 90,000 rand, let's say that there's inflation or something, whatever happened, and the value of the car is increased. Right? I don't record in my balance sheet that now the value of my car is 90,000 rand. I record it at the original value that I bought it, 80,000 rand, minus wear and tear or minus depreciation. That's how I record it. I don't record the current value that I think that is like buildings, for example. If you check the F&B building, right? They might have bought that building in 2000, in the year 2000, for maybe 3 billion rand. But now probably it's worth 10 billion rand. But if you look at their statements, they might record it as 3 billion rand, still as 3 billion rand, and not change the value. So that is what is called the historic concept. Again, I know this statement, this confuses a lot of students, but when we go into accounting, there is a revaluation, etc., that can happen, but it's not important for now. Let's not talk about that. Record your assets at the historic cost or the original cost at which you bought the asset, less the depreciation or wear and tear of that particular asset. Right. Next one is double entry. Double entry is what I showed you when we're doing the accounting equation. For every debit entry, there is going to be a credit entry. For every entry that you make in your account, you should always balance. That's where double entry comes in. You should always, because if you only have one-sided entries, then you're going to see your equation is not going to what? Is not going to balance. You have to have a debit and a credit in the what? In the books of a what? Of a business. So we're going to probably talk a little bit more about this when we do adjustments. But you should always have a debit and you should always have a credit entry. But for now, I will just leave it at that. Just know that as a student. But when we get a little bit deeper, I'll show you what we mean by debit and credit. Right. Next one is going concern. Going concern simply means that when I am doing my business, I assume that this business is going to be operating next year. It's going to be operating next year, but one. When I am doing my transactions, when I am valuing the business, I don't think that it's going to close down next year. I don't think it's going to close down next week. If I think that the business is no longer a going concern, then I cannot use historic concept. Remember, we talked about what? About historic concept. So this historic concept only works if I have assumed the going concern concept. I've assumed that the business is operating in perpetuity, that the business will be there next year. But if I don't think so, then I cannot use the historic concept. I have to re-evaluate the assets of the business. Right. Next one, accounting period. The accounting period of a business is usually 1 year, unless otherwise stated. It's usually 1 year. So for you guys, just know it's 1 year, because that's what your lecturer does. I've not seen anywhere where he's not used 1 year. So the accounting period of a business is 1 year. But what you have to be careful about is what really is 1 year. 1 year can be from January to December. That's 1 year, January to December. Or alternatively, it can be from 1 March 2020 up to 28 February 2021. That's still 1 year, because 1 year is just 12 months. Where you started doesn't matter, but it's still what? It's still 12 months. So that's where you have to be careful about, because your lecturer likes using 1 March up to 28 February. Usually that's what the SARS uses, right? 1 March up to 28 February the following year. That's what he usually likes. But sometimes he uses January to December. But all you have to know is accounting period is 1 year. The accounting period concept is important when we come to expenses and when it comes to income, because you need to know what you're doing. So when you're presenting your accounting information, you should only present information for the chosen period. If I say this is the statement of income for the year 2020, if there's income from 2021, it should not be there. If there's an expense from 2021, it should not be there. I'm only reporting for 2020. Please take note of that. Right? Then matching concept. Matching concept was saying that the income that has been earned in a particular year should be matched to the expenses attributable to that income. So for example, if you're doing a project, right? Let's say that you are a construction company, right? And you've been given a tender to build a road, right? And your tender is, let's say, worth 10 million rand, right? And you're going to do your tender in 3 years. That's an assumption. You're going to do your tender in 3 years, the tender is worth 10 million rand. So the government says that we are going to give you your money in year number 3 at the end of the period. That's what the government says. We're going to give you your money in year number 3, but start the project right now. So if you do the project right now, and this year you accrue some expenses, those expenses should be matched with income. So you're going to take money that you're supposed to be receiving in 3 years' time and apportion some of that money to the expenses that you accrued this year. And when you go into year number 2, the expenses in year number 2, you're going to take money from that 3rd year and apportion it to year number 2. So that's what we're saying. You're saying you are matching. If 50% of the expenses are in year number 1, therefore 50% of the income should be given to year number 1. If 20% of the expenses are in year number 2, therefore 20% of the income should be apportioned to year number 2. You are matching your revenue and expenses if your business is spanning over different years. So that's matching concept, right? Then conservatism, right? This one is where we say that don't overestimate your profit as a business, right? Do not overestimate your profits as a business. Do not overestimate your profits as a business. You have to be conservative, or do not underestimate your losses as a business. So when I say underestimate your losses, I want to give you an example. Let's say that Jabulani, right, owes me money, 500,000 rand. Jabulani owes me 500,000 rand, right? And I know that Jabulani is broke. I know that Jabulani is getting maybe 100,000 salary. So he's not going to pay me my money back. Most likely Jabulani will pay me 200,000 rand. But other than 200,000 rand, I will never get any cent after that from Jabulani. So do I record in my business that Jabulani owes me 500,000 rand, or do I only record the 200,000 that I know that Jabulani will pay me? That's the question to you as the student, right? So under conservatism, we are saying, I know that Jabulani, although he owes me 500,000 rand, he does not have the capability nor the capacity to pay me the money that he owes. So I will only record the money that I am sure or positive that I am going to get. So that is why we have got bad debts and provision for bad debts in a particular business. That's conservatism. We are saying we do not want to underestimate our losses. If we expect that we are going to have losses, let's record our losses. If we expect that we are not going to have profit, we should not record that profit, right? Because we're not going to have it. So why am I recording it, right? So that's conservatism, right? Next one is the realization principle. So realization principle is we record income as soon as it is earned and realized. But if it is not earned and realized, we do not want to record it. But income, as soon as it is earned and realized, we need to record it. So it's almost the same thing to do with the issues of the matching concept and whatnot. If we see that this income hasn't been earned and realized, we have to record it. So for example, a subscription. If someone subscribes for our services and we are pretty sure that they are going to pay us for those services, we have to record that as income, even though the actual cash has not been received. So someone has signed a contract with us that in 2023, can you please build this house for me in 2023? And we are sure that this person is going to pay us money. We don't have any doubt that this person is going to pay us money. We record the income. We have income, a house that we're going to build for 300,000 rand. So we record it under our income for 2023. Although the actual physical cash, we might receive it on 1 January 2024. But we record the income that has been earned and that has been realized for this particular business. Accrual concept. If we look at our expenses, if this year we use water from the city council and we use electricity from ESCOM, and the city council and ESCOM send us a bill of 50,000 rand to the company, even if we do not pay the bill this year in 2023, and we decide to pay it next year, June 2024, the expense should be recorded in 2023 when it was accrued. We should not wait for the physical movement of cash for us to record that we had an expense, right? That's accrual principle. As soon as we have realized the expense, we know that we use this water in 2023. We use this electricity in 2023. Yet we haven't paid city council because maybe we don't have money, but we have to realize this expense and record it in the correct year, right? So that's the accrual principle, right? So those are the different accounting principles that you guys need to understand. So again, like I've highlighted, remember I told you these guys on Thursday, these lessons are mainly focused towards guys that are doing the BBA, that are doing BCom in supply chain, that are doing ITM and whatnot. But for the guys that are doing BCom in accounting, you're going to have separate classes. I believe they start next week on Sunday. You're going to go deeper into these things. You're going to be talking about this is FRA 6, this FRA 7 and whatnot. You're going to go deeper into these things, right? Because you're going to have separate classes for that. But for the other guys who are just doing financial reporting and analysis, straightforward. What we've just done right now is exactly what you need to know. Then you are going to apply these concepts. When we start doing the financial statements, you're going to apply these various concepts. Are there any questions on the concepts? I think we're only left with 2 small topics for today. Are there any questions on the concepts? No questions. That's good. All right. So now I want to talk about 2 things, and then we can be done for today. I want to talk about the limitations of financial statements, and I want to talk about the characteristics of good financial statements. Right. So this is a bit of theory. This usually you get it maybe in your KCQs, but I rarely see questions on these ones. I rarely see questions on these ones. Right. In terms of the exam, you don't need to worry about this part, but it's usually not in your exam, but maybe for your assignments, for your KCQs, but we're going to do them together. All right. So limitations, what are the problems that are associated when you are creating financial statements? Number 1, remember we said the historic cost. So just think of it. If I bought a building for 3 billion in 2000, and now the building is worth 8 billion, but I'm still recording it as 3 billion, that feels like there's something fishy there. It's not correct. Right? So that's one of the limitations, that sometimes when you look at the value of the company, it might be understated because they are using the historic cost to value their assets. So their assets might be worth more, right? They might be worth much, much more than they actually are in real life, right? That's number 1. Number 2, inflation, right? So when we're presenting our accounts, they don't account for inflation. So I might say the company made a profit of 1 million this year, and next year it made a profit of 1,100,000. But if the inflation rate in the country was very, very high, they might actually have been a decline in profitability rather than an increase. So financial statements do not show inflation. Therefore, it becomes a problem in countries where there is hyperinflationary environments. Right. Then number 3, accounting statements. Remember, we said that this is money that we're talking about, not money, not physical things. So they will show you that this business is 1 million in buildings, but they will not tell you how many buildings the business has. They will tell you that this business paid 30,000 in wages and salaries, but they will not tell you how many employees does the business have. How many of the employees have degrees in the business? You see, so that's a problem because it does not really tell you much. It just tells you that we paid 30,000 for our employees. But are our employees good? Is their performance increasing or is it declining? Do we have people with degrees or with people who do not have degrees? Right. Then accounting or financial statements, they look backwards. This is why we need to do managerial accounting next year. They look backwards. They look at the past. But what if something is already changed? So for example, I might say the business made a loss of 30,000 rand. But if the same business that has made a loss, if they have a contract next year where they already are going to supply maybe 1 million things to their customers, that business is okay because it is a contract where it's going to supply. Right. So even if they made a loss last year, they are still okay because they are still going to be in business. So it is very important to also look into the future of a business. Then, although most companies will follow GAAP or IFRS, there are some differences that you might still find in terms of the accounting policies that organizations use, and that will result in problems in terms of comparing things. Then lastly, there's what we call unrecorded value or intangible assets. Remember, I talked about intangible assets, assets that you cannot hold. These assets that you cannot hold, most of them, they're usually not recorded. For example, if you look at Kingsley, which produces Coke in South Africa, right, versus Coca-Cola, right? You can say, Kingsley has got these assets, Coca-Cola has got these assets. But the brand name Coca-Cola itself is an asset. Just saying that this is a Coke will make someone buy it. This is produced by Coca-Cola. So Coca-Cola, if today they produce a new drink and put it out there, you all go and buy it because you trust Coca-Cola. But that is not recorded on the balance sheet of Coca-Cola. So that's unrecorded value. So those are the limitations of financial statements. Then characteristics of good financial statements. What can we say that, if I look at your financial statements, I can say, this is good. You have done them very, very well. Number one, if I understand them. I should be able to understand what you're trying to present. I should be able to tell, was there a profit? Was there a loss? What is the value of this company? So they should be understandable. They should be presentable, right? They should be relevant. They should give you the correct information that you need. They should have, what do you call it? Separation between assets and liabilities, between current assets and current liabilities and whatnot. They should be relevant. They should give you information that you actually need. If a business is in entertainment, it should tell you how many hours did people watch of this particular business. That's relevant information that I need to know. If a business is in transportation, it should tell me how many delivery vehicles does the business have, right? They should be relevant information. Otherwise, what's the point? Right? It should be prudent. Prudent, remember the concept that we talked about, conservatism, right? There should be no revenues that are overstated and no costs that are understated. I.e., there should be no bias in the way we've presented them, right? Neutral, we are saying that when you're presenting your statements, they should not just where you're looking at the statements, and maybe they are presented in a way where only the owners of the business are happy, or maybe only the government is happy, or maybe only the employees are happy. They should be presented in a way where everyone can look at the statements and get the information that they want from those statements. Reliable, which means that you should have used the correct things. People should reliably know that, look, if I look at these statements, they are correct. Usually to do this, we do auditing. So to make sure that they are reliable, we present our auditors' letters that the auditors have gone through these things. Complete, there should be no missing information. Everything that needs to be there should be there. Comparable, it means that they should be similar to other companies. If it's F&B, the way they present their information should be similar to Capitec, should be similar to all the other banks. If it's ShopRite, the way they present their information should be similar to Checkers, should be similar to Spar, so that you can compare between Checkers, Spar, and ShopRite at the end of the day. So, ladies and gentlemen, this brings me to the end of the main stuff that I wanted to talk about under unit number 1 for today. So before I open it up for questions, the next time we are going to meet, we are going to go to 1.8, which is summarizing financial information in financial statements. So we are going to combine 1.8 and unit number 2. So we're essentially now going to go into unit number 2. Right? So under 1.8, we are mainly going to focus on Monday on the income statement, the statement of comprehensive income. If you have time during the weekend, just browse through the statement of comprehensive income. That's what we are going to be doing on Monday, the statement of comprehensive income. I'll also bring a past exam paper on Monday so that we can do it together, so that you can see how to do a statement of comprehensive income. Now, point of departure, right? When we are going to be teaching, I'll show you this on Monday. I'm going to bring a past exam paper and show you on Monday. But when we are teaching you guys, your exam has got 5 questions. 1 question will be statement of comprehensive income. 1 question will be a statement of, So one question will be statement of comprehensive income. 1 question will be a statement of financial position. 1 question will be statement of financial cash flows. 1 question will be the statement of changes in equity for a partnership account. And then 1 question will be ratio analysis. We're expected to calculate some ratios. So those are the 5 questions that you're going to see in your exam. So as we learn this information, we are going to focus, that's the approach that we are going to use. So what we've done so far from Thursday and today, this was just introduction. You're not going to see these things in the exam. This was just an introduction. But in your assignments, yes, you will see them in your assignments, but in the exam, you're not going to see this. But what we are starting to do on Monday is what you're going to see in the exam. So for this module, I'm just entirely going to be focusing mainly on exam preparation, because I want you guys to come up with the distinctions. So on Monday, we are starting on one of the questions, which is statement of comprehensive income. So I'm going to show you how to do it. I'm going to show you an exam paper we do together, and then I'm going to give you homework in the form of another exam paper. And when we meet the other time, we're going to revise again together so that you guys know how to do these things in an exam setup. Are there any questions for me? Any questions? Okay, let's see under the chat. Okay, I'll send the slides in the group. I'll send the slides in the group for those that want the slides. I'll send the slides. I also have got templates and whatnot, but I usually don't want to send the information before we do the topic, because I know people sometimes they get confused. So I'll also be, as we are doing the lessons, there are some templates, exam templates, in terms of if a question comes like this, you answer it this way, and etc. So I'll also be sending you guys those exam templates. There will be, some of them will be in Excel, so that it's copy and paste when you're in the exam setup. Right. So please don't miss Monday, because the question that we're going to do on Monday is exactly how it comes in the exam setup, so that you can see how to approach some of these questions in the in the exam. I thank you guys for showing up today. I know you're going to show up on Monday. Let's see together on Monday. Then please take note, there should be a lesson tomorrow for economics. There should be an introduction lesson for economics 1B tomorrow. There should be an introduction lesson for economics 1B tomorrow. But as for me, you will see me on Monday. Tomorrow you have Fortune for introduction to economics. I will introduce him to you guys. We'll talk a little bit, but he's the one who's going to be taking the class. It's 7 p.m. Our classes are at 7 p.m. Any of our classes are at 7 p.m. All right. So if there are no questions, I will consider you guys. You sleep well. We shall talk tomorrow evening.
Thank you.
Stop.
You.